understanding the process and requirements for SME IPO in the healthcare. Let's put our hands together and welcome our very esteemed speaker, Mr. Raj Sukheja. Ladies and gentlemen.
Thank you so much for being here. Appreciate the effort of the organizers and all my friends here, Dr. Prashant, Geeta ji, Pradeep ji, and the team. So I'll, without much ado, I'll start off with the presentation. So let's begin with how this whole story began. Early civilization. We saw that there was no, we basically were people who used to barter stuff. So we used to have something of value that would be given to someone else, and in exchange receive other products in similar value. And sooner than later, finally this turned into a currency. The currency story began with somebody discovering that a commodity could be created whereby we could address a value to this, and instead of a barter, we could put a value to each product or service. And then came us, the bankers. And that's where the trouble began. So, Red Mammoth Ventures is a company that I work with. They are advisory, they raise capital for companies in debt and equity. Some of our clients, some of the stuff we do and who we fund. So the question here is, are you looking to raise capital? That is the fundamental question that everybody tries to answer for their businesses. And every business requires capital at some point or the other. Whether they are able to get it or not is a big question. Whether they are prepared to get it or not is another question. Most companies, businesses feel that raising capital is a very simple deal until they experience it. Only when you experience the problems associated with raising money do you realize the importance of having money and having it in your pocket when you need it. Money has zero value when you don't require it, but when you do require it, at that moment, money plays a substantial role because it could stop your expansion. It could probably even halt your business, because money is the bloodline of any business. And raising capital is the preparedness that goes into raising capital, raising money for the fluidity, for the growth of your company. And if you don't prepare for it in advance, usually you will be in a tight spot. And then come all kinds of fixes like high interest, picking up money at whatever terms possible because you need to survive. Survival is not the game here. The game is growth. Every business needs to grow. And with growth, you need capital. Both are absolutely associated with each other. So are you aware of your options in raising capital? We have on one side the debt offers. Debt is basically a loan. It is something that you receive from an institution or a bank or an NBFC as a loan which you have to pay back within a specified period. It has an interest cost. It has a fixed cost in terms of the value you need to pay back for the principal. The debt may be secured or unsecured. If it's unsecured, there will be a risk associated with non-payment. It could affect your track record, it could affect your credibility, it could affect your reputation. For secured debt, you will have to provide collateral, which means you need to have something of value to give to the institution that gives you money. And it's not, and even if you do give something of value, it's not necessarily that the body will actually, the institution will actually give you that money because of one simple fact. Nowadays, no bank, no NBFC really looks at only the collateral in isolation. They also need to see the repayment capability in terms of who needs to pay and when, and can they pay? Is the repayment possible? Does the business have cash flows? Is the project viable? Is the promoter sound? Is his reputation good? Does he have a good credit? There's so many aspects to it. So receiving debt is no longer a simple issue anymore, even though you are collateralizing it. So when I say that about secured debt, when we talk about unsecured, it's another story completely. Now let's go to equity. What is equity? Equity is basically the shareholding, value for the shareholding that you have in your company and that you are willing to dilute it or create a premium for it and get certain monetary value in terms of money against your shares in the company that you hold. So debt is offered by banks, NBFCs, family offices, others. Equity is offered by direct investors, angel investors, venture capitalists, IPO, that's initial public offering, and others. Now this new concept of IPO, which is in a great demand nowadays. We keep hearing about this IPO or that IPO, and then there are modifications to the IPO format as well, which are basically now supporting a section called the SME, which is the small and medium enterprises. Earlier, IPO was purely for the big boys. IPO was purely for the big boys. It was the Adanis, the Ambanis, and all the Tatas who could afford to get an IPO in place and raise money from the public. IPO is sort of a crowdfunding deal. What is crowdfunding? It is smaller investors who can invest to put 1,000, 2,000, 5,000, 50,000 rupees, collectively coming together to buy some equity in your company, some shares in your company against a certain value. So when you look at 1 million shares being pledged out there, because the valuer or the exchange that decides on the valuation of your company actually is able to put a number to it, those number of shares that are pledged with the public or given to the public as shareholders or owners gives you considerable value back without interest. So basically, an equity deal is without interest. There's no cost to the equity for the businessman except when it makes profit. And nor does he hold a risk over it unless he misuses the equity in certain amount received from the equity in a certain fashion. So assuming I have a company and I want to raise, let's say, 10 crore rupees. My share value is at par value is 10 rupees. I have done sufficient amount of business and now the valuation of my company is up 100 rupees a share. I can go to the regulatory authorities, which is the exchanges, and ask the public to buy or rather become shareholders in my company at 100 rupees as on current market value, and I can raise those 10 crore rupees by way of each investor even putting 1,000 rupees at one time. So that makes it very easy to get money because the investors are small and it is a number of investors that are coming together to give money to you. Finding a person who will give you 1 crore rupees at one time or finding 100 people giving you 1,000 or 10,000 rupees is a different aspect completely. So in expanding to that, so equity deals usually work for businesses that can offer mid and long-term awards. like the IPOs. To the investors, which may be fluctuating but sizable. So rewards are fluctuating. Today the company will be doing well, your share price might be higher. It might not do well in the future, your price might drop down, or it may double, it may triple, it may 10x or 12x or 20x or whatever. So the risk is higher and the rewards are higher. In a debt deal, the risk is fixed because you've got a collateral, or at least you have a credible party who's taken the money from you and is giving you month-on-month interest. Now let's talk about SME IPO. This is the topic we have come for today. So the SME IPO is basically an IPO launched and set up by the authorities to give SME a footing in the market to raise money. Because like I said, earlier the big boys used to play. Now the SME has an opportunity to raise money in the same format. And the entry is fairly easy rather than more difficult like the normal main board IPOs that happen all the time. The criteria is, so they have established a separate SME IPO platform, both the BSE and the NSE, that's the Bombay Stock Exchange and the National Stock Exchange. And the criteria is that post-issue paid-up capital of the company issuing SME IPO should not exceed 25 crores, which means post-issue means the issue is completed. The paid-up capital cannot be 25 crores, more than 25 crores. Whereas in a main board, the minimum is 10 crores. It can be 500 crores, can be 1,000 crores, can be any number. So this could be a post-issue paid-up capital of even 1 crore, 2 crores, 5 crores, whatever the amount may be. So it makes it easy for a common, not a common, I'm sorry, but a small business to actually float an SME IPO issue. The company should have been incorporated under the Income Companies Act 1956. It should have a positive net worth and a website. The net tangible assets of the company should be 1.5 crores. The company should have a track record, operations of at least 3 years. Should be funded by banks, financial institutions, central government or state. If the company does not have a track record of 3 years. Now in an IPO, a main board IPO, this is mandatory 3 years. In an SME IPO, it's not. So even if you're less than 3 years and you've been funded by a central government agency or a funding or a FII, you still have the option of getting into an SME IPO. So it cuts down the duration of your life, the startup. So a company that is formed today or formed maybe 3-4 years ago and has a positive net worth can actually look at going for an IPO today. The company should have an agreement with both Indian depositories, CDSL and NSDL. These are the demat issuing authorities. These are depositories where you actually, they convert your shares into digital. The list of promoters should not have changed in the preceding year. So you can't have an IPO today. Let's say I'm a director in a company and I am exiting the company and bringing new directors, and then I go for an IPO. It will not be acceptable because I need to be there for a few years in the company at the bare minimum. So that the sustainability is seen. Promoters are the mainstay of any company. If the promoter is not willing to take a responsibility or for the growth of the company, it automatically means that there is something wrong with it. The company should submit a certificate to BSE stating that the company is currently not under any board for industrial, that's BIFR. So basically the company, they are saying that the company should not be under winding up proceedings, should not have any bankruptcy issues going on, should not have any claims against it which are dubious or in court. Now, what we discussed earlier was the BSE aspect of the SME IPO. Now, there's another platform called the NSE Emerge. It's very, very similar. There's hardly any difference in both, except that the promoters should individually or jointly hold at least 20% of the share capital. This holds very much true to the BSE aspect as well. But the difference here is the BSE platform is far more efficient than the NSE platform. Specifically, why? Because there is an answering mechanism. There are people who will respond to you, and they are very, what would I call the word? Very aggressive in terms of assisting you to actually reach your goals for an entrepreneur. It is very difficult. See, for an entrepreneur to start up a journey for an IPO means investment, means time, money and time both have to be invested. Merchant bankers get involved, banking gets involved, auditors get involved, all the accounting compliances need to be seen that they are sorted out. People like us get involved, then the underwriters get involved. And there is such a large traction of interaction between the experts who basically bring the structure to your company. Because once it goes public, it is public information. Anybody can access information on your company at any given time. It's online. So there's no scope to play around. And therefore, in order to ensure transparency, there are a lot of compliances that need to be followed, a lot of procedures that need to be followed, a lot of experts need to be coming onto board to actually deliver onto the results. And Bombay Stock Exchange has been very, very aggressive. I think they've done their 400th SME IPO recently. And SME IPOs have seen a 130% jump in terms of collection in 2023. So this is the difference between the main board IPO and an SME IPO. So main board IPO, stringent and complex eligibility norms. SME IPO is relaxed. Eligibility norms are not as hard as they are on an IPO, normal IPO. Should have a minimum post-issue of 10 crores. This is minimum, and that is maximum 25 crores. Documents get vetted by SEBI, documents vetted by stock exchanges. So there's actual support there from the exchange. If there's a problem, they'll tell you, you can solve it. But this is Securities Exchange Board of India. So it's more of a compliance issue there. Market making is non-mandatory. Their market making is mandatory for 3 years. So merchant banks are actually, bankers are actually hand-holding you. They are supporting your entire effort by taking you to the stock exchange, by supporting you throughout the journey until you reach the goal that you're looking at. Need to file quarterly audited accounts, need to file half-yearly. That saves a lot of compliance issues, a lot of time. IPO underwriting is not mandatory in a main board IPO, so the risk is carried by the main board IPO. Whereas underwriting, IPO underwriting is mandatory, of which 15% should be underwritten by the merchant banker. This gives a lot of confidence when the merchant banker is actually investing 15% of his own money in the promoter's account that he's managing. It means there is a lot in the company that needs to be recognized. The minimum IPO application size is 10,000 to 15,000. The minimum IPO application is 1 lakh for SME IPO. Listing and trading on NSE, BSE, BSE SME and NSE Emerge. So this is a small example of what has happened. When SME exchanges came into play, no one expected them to be successful. There is a gentleman in Bombay called Mr. Ajay Thakur, who is the BSc head of SME. And this gentleman is an advisor for us as well. And he is a thorough gentleman and has supported this whole concept and has brought it to this level today. It is due to the efforts of this gentleman that actually this story stands. So we are looking at a 2,229 crore collected, which is a 130% jump in SME IPO space itself in 23. At that point, I'll take your leave, and if you have any questions, I am more than happy to answer them.